الشيطان الرجيم بسم الله الرحمن الرحيم ربي اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي. So today we shall continue with our lesson. Last week we were talking about the income statement, and we talked in detail about what an income statement is and also the elements of an income statement. And we also said that sometimes the income statement is also known as the profit and loss account. So basically, the profit and loss account or the income statement, it helps us to know whether as a business we are making profit or we are making loss. So it basically has the revenue part, and it also has the expenses part. So the differences between the two is what will help us at the day to know our margin. Now today, this is the second important type of the financial statement is the balance sheet. Remember in our last lesson, we said that they are three important financial statements that as a business student or as a business person, you need to know. So we have the income statement, we have the balance sheet, then we have the cash flow statement. So in our last lesson, we discussed in detail about the cash, we discussed in detail about the income statement. So today we shall be talking about the two types. So number one, we have the balance sheet. So what is a balance sheet? So a balance sheet is a financial statement that reports a company's number one, assets, liabilities, and shareholder equity at a specific point in time. So from this definition, we can learn or we get to know the three important components of a balance sheet. That is, we have the assets, the liabilities, and the shareholders' equity. Now, a balance sheet is one of the three main financial statements used to assess a company's financial health at a specific point in time. So if you want to know how well we are doing, so the investors, the stakeholders, they'll always analyze your balance sheet. So from your balance sheet, somebody can easily know that your business is doing well or your business is not doing okay. So it provides a snapshot. It provides a snapshot of what? A snapshot of a company's assets, liabilities, and equity. And it follows the accounting equation. So number one, we have the assets al-usul. This is what the company owns, mumtalakat al-sharika or al-munazama, including, so we have two types of assets. We have the current assets, which can be cash, inventory, and what? Receivables. Then we also have the non-current assets. The non-current assets, we have the properties, plant, and equipment. Number two, we have the liabilities. This is what the company owes, including current liabilities. Accounts payable basically means that, for example, your suppliers, they supplied you with some goods. You need to pay them back. Short-term debts, mathalan, you go to a bank, you take a short-term loan that you're supposed to pay, maybe anything that you're supposed to pay within 6 months. It's a short term. And you have the long-term liabilities, anything above 6 months. For example, if you take a loan and you're supposed to repay it in 7 months, 8 months, then that is a long-term debt. Then you have bonds payable. Number three, we have equity. Equity is the residual interest in the asset of the company after deducting liabilities, representing the owners or shareholders' stake. So equity, as we saw in our previous lesson, is when we take our asset and minus the liabilities, then what remains is what is known as equity. So it is assets minus liabilities. So what remains is what is called as the residual interest. Now, the balance sheet is one of the key financial statements used by businesses to provide a snapshot of their financial position at a specific point in time. We've already said this. So it offers a summary, mulakhas, of what a company owes, the assets, what it owes, liabilities, and the equity that belongs to the owners or shareholders. The balance sheet follows the fundamental accounting equation. This equation is very important because all the accounts revolves around this equation. Now, this equation highlights that the resources owned by the company, which are the assets, are financed either by borrowing, liabilities, or by the owner's investment equity. This statement is very important. So they are telling us the resources that an organization has, okay, can be financed from two sources. So number one, through liabilities, borrowing. So sometimes you'll go to a bank and borrow some money, and this money you're going to use in your business. So anything you have in your business, it is being financed, number one, by liabilities. You take loans from other people. Then number two, anything in your business is being financed by yourself, your capital. So you are giving, you are injecting capital into your business. Now, so these are the components of the balance sheet. For example, in an exam, you can be asked a question about the components of a balance sheet. So number one, we have the assets. And these are the resources owned by the company that are expected to provide future economic benefits. So anything that we expect to give us some value in our business is known as an asset. And the assets are divided into two. So we have the current assets, and these are assets that are expected to be converted into cash or consumed within 1 year or one operating cycle, whichever is longer. So common current assets include, so for example, if you have cash and anything that is equivalent to cash, then that is a current assets. Accounts receivables, money owed to the company by customers. So you have your customers, they come to your shop and they buy things, but they tell you, okay, Muhammad, we will pay you in future. So that is a current asset. So money owed to the company by customers. Inventory, these are what? When you're talking about inventories, al-makhazin, al-makhzunat, anything inside your store. So if you are selling products, those products are known as inventories. Then prepaid expenses, payment made in advance for services or goods. Sometimes you pay for services and goods in advance. So that is an asset to you. Then we also have short-term investment. Then non-current assets. This is what is known as al-usul al-thabita. Usul al-thabita. So these are long-term assets that are not expected to be converted into cash within one. It's very difficult to convert them. If you want to convert them into cash, then it's going to take a lot of time. So they typically provide value over a longer period. Common non-current assets, for example, property. For example, the building that you are on, you have as a business, that is your property, right? The plant, for example, you're having a factory. Equipment, anything you're using, the machines you're using in production, all those are your assets. So tangible buildings, machineries, land, ila ghayri dhalik. Then we have intangible assets. These are the non-physical assets such as patent, trademarks, and goodwill. So sometimes in your business, you have what is known as intangible assets. So, for example, you are having your business, the name of your business, the name of your business is an asset. The name of your business is an asset. Because sometimes people come to buy from your shop because you have a very good name. So the repetition. So it's an asset, but it is intangible. The name, just like Nike, Adidas, they are names. People normally go to buy those because they have good names. Those who are talking, please, can you stop disturbing the class? You are in class and you are talking. Can you keep quiet? Who is this? If you want to talk, please just go somewhere else. Then number 2, we have the liabilities. These are the obligations that the company owes to external parties, which are expected to be settled in the future. So anything that the company owes other people. So similar to assets, they are classified into 2. So we have the current liabilities. These are the current obligations. These are liabilities that are due within 1 year or 1 operating cycle. Common current liabilities include accounts payable, money owed to supply. So there are 2 categories. We have current liabilities. I don't know why students are making noise. These are liabilities that are due within 1 year or 1 operating cycle. Common current liabilities include accounts payable. This is money owed to suppliers or vendors. So sometimes there are people who supply your business with products. Sometimes they supply and you just tell them you'll pay them in future. So that is a liability, something that you'll have to do what? To pay in future. Then short-term debts, loans or borrowing due within 1 year. So these are short-term loans you're supposed to pay within a year. Accrued expenses, expenses incurred but not yet paid. Sometimes you have some expenses but they are not yet paid. For example, wages and taxes. So sometimes you have people who are working with you, but you take time before you pay them. So for example, Mohammed is working in your business. The end of the month comes, you are supposed to pay Mohammed on the 1st, but you tell Mohammed, I'll pay you on the 15th. So that is an accrued expense. And sometimes even the taxes, sometimes you are supposed to pay the taxes, for example, the income tax at the end of the month, but then sometimes you delay in paying the taxes. So that is an accrued expense. Then deferred revenue. These are payments received from customers for goods or services to be provided. So sometimes your customers, they pay you money before you do what? Before you supply, before you give them the products. So that is also a liability, a deferred revenue. So the customer has paid you money, musbikan, but you've not yet given the customer the products. Then we have the non-current liabilities. These are long-term obligations due beyond 1 year. Common non-current liabilities include long-term debt. If you go to a bank, and for example, you're given a loan and you're expected to pay after 3-4 years. Sometimes you can lease a land. Sometimes you can lease a house. So when you are leasing, they give you some time. For example, you can lease a land to do what? to practice agriculture for like 10 years. Then lastly, you have the equity. So this represents the ownership interest in the company. It is essentially what remains after subtracting liabilities from assets. This is what we said. So you subtract the assets, the liabilities from the assets. So what remains is your equity. So we have the common stock, the value of shares issued to shareholders as part of the ownership. So if you have any company, sometimes you can have shares, for example, with Dahabshil, you can have shares in Premier Bank, you can have shares in any company. If the company gets profit, then also the value of your shares keeps increasing. If the company gets loss, then even your shares, the prices of your shares will be affected. Then retain earning. Retain earning means, for example, you're having a business. At the end of the year, you get a good profit. So sometimes some businesses, when they get this profit, they don't, they either reinvest it or some of them they use in their personal things. But sometimes when you get a profit, you can reinvest it or you can retain it in your account. So when you're talking about retained earning, this is something that goes to your account after you get a very good profit. So from your profit, you normally invest part of it, you reinvest, and you retain, put it in your account. Now, so this is so here we have an example of what? We have an example of a balance sheet, So this is ABC Widget's balance sheet as of December 31st. So always when you are preparing a balance sheet, you need to have the heading for the balance sheet. So in this case, this is ABC Widget's balance sheet, and you also need to have the period of what? The period of the time. Now, so if you see, we have the asset side, and we have the what? And you have the liabilities side. So we have the current assets. So you normally have the current assets and their values. So here you have the cash, account receivables, inventory, prepaid expenses. So all of this, so our current assets, the total of our current asset is 47,000. The non-current assets, these are the usul thabita. We have equipment, depreciation equipment. So we have 25 less because it is depreciating. So this is amount that is depreciating. So anything in brackets, it's minus. So our total non-current assets is 20,000. That is the 25,000 minus the 5,000. Now our total assets will be 47,000 plus the 20,000. That is the 67,000. Now, we also have the liability side. So we have the current liabilities, plus we also have the what? We also have the non-current liabilities. So the total current liabilities is 8,000, then plus the non-current gives you what? So our total liability is 18,000. Now, on the flip side, we have the equity. We have our common stock, the retained earning. Now our total equity is what? Is 49,000. So the total liabilities and the total equity is 67,000. So sometimes in an exam, what normally happens in an exam is you are given the information, you are given the assets, you are given the liabilities, you are given the equity. So your responsibility, so they give you all the information. In an exam, you will be given all the information and they will tell you to do what? And they will tell you to prepare a balance sheet. At the end of the day, this is very important. Your balance sheet has to be balanced. So in our case, you can find that we have our total assets is 67,000, and our total liabilities plus the equity is what? Is 67,000. So the total equity is 49,000 plus the 18,000. So you get what? You get 67,000. So this is just but explanation. So here they're explaining to you this whatever the balance is. They're explaining each and every component and how they arrived at the figure. So during your free time, you can just read and understand how this is being done. So they're explaining each and every item in the balance sheet. Okay. And at the end of the day, it needs to be balanced, you know. And if you want to know it is balanced, you can use the accounting equation. So for example, our total assets from the table, you can easily know what is the total. Our total assets is 67,000. Our total liabilities is 18. Then our total equity. So you can get all these figures from the balance sheet. So at the end of the day, it has to be balanced. This side, the left side, it has to be balanced with the other side. If it is not balanced, it means there is a problem somewhere. So this is very easy. So in an exam, you'll just be given the what? You'll just be given the figures and the amounts, and they'll ask you to prepare a balance sheet. As easy as that. Now, what is the importance of the balance sheet? Number one, it provides a snapshot of the financial position. So it gives us a picture of our assets, liabilities, and equity. So we can easily know our financial health. Number two, assessment of liquidity. So through the balance sheet, we can easily assess the what? Our liquidity. And in our next lesson next week, we shall be talking about the liquidity ratios. How can you calculate the liquidity of your what? The liquidity of your company. And when you're talking about liquidity, we are basically saying, can you be able to meet your short-term obligations? So the balance sheet is used to assess a company's liquidity, which is its ability to meet short-term obligation. And you can be asked in an exam, for example, what is liquidity? Define liquidity. So liquidity is the ability to meet short-term obligation by examining current assets versus current liabilities. So if you want to know your liquidity, there is what is known as liquidity ratio. You take your current assets. So for example, if this is our balance sheet, so here they're basically telling us when you're talking about liquidity, so you just take your current asset versus current liabilities. So when you come here, for example, our current asset is 47,000. Okay? Then we divide it by the total current liabilities, which is 8,000. So if you want to know your liquidity, you take the total current assets, which is 47,000, then you divide by what? By 8,000. So you will know your position. If the figure you'll get is negative, or if the ratio will be more than 0.5, then you're in a good position. But if it will be a negative number, it's a red flag. It means your liabilities are more than the assets. Then understanding leverage and solvency. So the balance sheet helps analyze a company's leverage, the use of debt, and solvency, the ability to meet the long-term obligation. This is very important. And even in the last lesson, I told you. So we have liquidity and we have solvency. Sometimes you can be asked, what is the difference between liquidity and solvency? Liquidity is your ability as an organization to meet your short-term obligation. On the flip side, solvency is your ability to meet your long-term obligation. Long-term obligation. Now, so the balance sheet can help us to know our solvency. And when you are talking of a company's leverage, when you are talking about a company's leverage, we are basically talking about the use of debt. Some companies, if you go to their balance sheet, you will realize that their business is being financed by a lot of loan. So sometimes people normally argue. Sometimes some people normally argue, like, is it good for your business to be financed by loans? So that is an argument that so I don't know what is your feeling related to this. Do you think that you should always take a lot of loans to finance your business, or you should avoid loans? So sometimes in an exam, you can be asked this question: what is the best approach? Like, is it good to always finance your business by loans, which you'll have to pay and maybe pay by interest, or it is good to avoid the loan? So there is no, it's not a black white answer. There is no, it can be good. So it has its advantages and disadvantages, you know? So sometimes, mathalan, when it is good to use loans so that opportunities don't pass by. Sometimes you have a lot of opportunities, but you don't have enough money. So if you want to capitalize on the opportunities, you will go to a bank to take a loan so that you don't miss this opportunity. So taking loan can help you not to miss the opportunities. But sometimes also, when you are taking this loan, and sometimes this loan has interest, and maybe sometimes your business is not doing well, so it means you will not be able to repay the loan. So it is something that has advantages and disadvantages. Some business, mashallah, they're doing very, very well because of the loans. Of course, in Islam, when you're taking loans from the banks, you know, the loans don't have riba. So it is good. So if you think that you want to expand your business, Fabia wa Ne'ma, you can take the interest-free loans. So number 4, evaluating financial health. If you want to know if we are doing well financially or we are not doing well, the balance sheet can also help us. Then also supporting investment decisions. The balance sheet is crucial in making informed decisions. It allows potential investors to evaluate the company's worth and financial ability before committing their money. I want to invest in your business. Before I invest in your business, I'm going to ask you, I need your balance sheet. I need to see your balance sheet before I put my money, before we partner in the business. Because I don't want to put my money in a business that is dying. So you'll give me your balance sheet. I will analyze your assets. I will analyze your liabilities. I will analyze your equity. So this information will help me to make a decision. Then aiding in strategic planning. Remember, when you're talking about strategic planning, we are talking about takhtit lil mustaqbal. And takhtit lil mustaqbal yahtaj ila al mawarid. You need to have resources. So the balance sheet will help us to know the resources that we are having. Then these resources can help us to plan for the future. But we cannot plan if we don't know the resources that we are having. So the balance sheet will help us with that information. Number 2, the next one, compliance, and reporting. So companies are typically required by law, any country, by law, to prepare and present balance sheets along with other financial statements. So in many countries, you are required by the revenue authorities. So for example, in Somalia, maybe you have the revenue authority. The revenue authority, they'll always ask you for the what? For your financial statement. Then number two, when you are presenting these financial statements, it shows that you are being transparent. So this transparency helps maintain accountability to stakeholders, including regulators, investors, and creditors. Then lastly, facilitating ratio analysis. The balance sheet is used in various financial ratios, as we shall see next week, such as the current ratio. If we want to calculate, to know our what? To calculate our current ratio, we will use the balance sheet. There is the debt to equity ratio, we will use the balance sheet. And return on equity, we have to use the balance sheet. So the balance sheet will help us when we are analyzing our ratios, as we shall see next week. Now, the next part of our lesson is about the what? The cash flow statement. So we are through with the what? We are through with the financials. We are through with the balance sheet. So the last statement is the cash flow statement. So what is the cash flow statement? So it's a financial statement that aggregates a company's cash inflow and outflow from operations, investing, and financing over a set period of time. So in this definition, there are 3 or 4 important things. Number one, the cash flow statement, it helps us to know the inflow and the outflow. Okay, number two, in every business, we have 3 important operations where money involves. So we have the operations. So what are the monies from operations? What are the money in investment? Then what are the money in financing? Those 3 areas. So the cash flow statement tracks the movement of cash in and out of a business, categorized into 3 main sections. Any business in this world normally operate under these 3 activities. Number 1, we have the operating activities. Number 2, investing activities. Then number 3, financing activities. So this statement reflects a business ability to generate cash to fund its operation. Number 2, pay its debts. Then lastly, reinvest in the company. So this cash flow is going to help us. Like, it will help us to know, can we generate more money to pay salaries? Can we generate more money to run our business? Can we generate more money to pay Al-Duyun? Because we need money to pay Al-Duyun. But if we don't have money, we cannot pay Al-Duyun. Then number 3, can we get money to reinvest? الاستثمار يحتاج إلى النقود. So this cash flow statement can help us make decisions related to operations, related to paying our loans, and related to reinvesting. The more money we have, the more we can reinvest. The more cash we have, we can pay our debt. And the more money we have, we can easily run our business. So I think we don't have enough time. We have only 3 minutes remaining. So that will be the end of our lesson today. So today, in this lesson, I'm going to take a picture. I'm going to Today I did not I did not prepare the link for the attendance. And today we'll get those who don't attend, because there are 21 students, there are 24 students here now. But now when you go to the link, sometimes you will find 43 students. So I don't know where these 43 students normally come from. I don't know, frankly speaking. So just let me take a screenshot. So some students, they don't attend the lesson. They just come for attendance. Okay, I think I've already taken. If you know you're in class, can you also please take the picture, so that if I send the picture, your name is not there, you send me your screenshot with the name. So please take your copy of the screenshot. If I send the screenshot in the group and it does not have your name, there are 24 students. But when I send the link, sometimes you will find 49 students. 49. So I think I'll just be taking pictures of those students who are around. So is there any question? So next week will be our last. Next week will be our last lesson for this course. And next week, you'll also be doing your quiz. Prepare for your quiz next week, inshallah. Is there any question? If you have any question, you can ask. Yes, Abdullah.
Teacher, I have a question. You mean next week for Friday or Thursday?
No, on Thursday we will have the lesson. Then the quiz will be Friday. So on Thursday you will have the lesson, normal lesson. Then on Friday you will have your quiz. Then maybe the other week you'll have your final exam. So I will explain to you more about the quiz tomorrow. I'll give you some information about the quiz.
Okay, next Friday for next night we have a lesson.
Yes, tomorrow you are having lesson. So tomorrow you are going to have your lesson. Then next week, Thursday, you'll have lesson. But the Friday of next week, you'll have your quiz.
Okay, thank you, Ustad.
Okay. Any other question? Any other question, please? So the quiz